I'm Charlotte McLeod with the Investing News Network, and here today with me is Chris Temple, founder, editor, and publisher of The National Investor. Thank you so much for joining me online today. Great to have you here.
Hey, it's my privilege. Good to be with you, Charlotte. I've followed you guys and your work particularly for a while, so I'm happy to be part of it today.
Oh, well, I'm so glad that we can connect. And, you mentioned it's our first time talking. So where I thought we could begin with is getting kind of a macro view from you on the market. I know that you see us heading toward a stagflationary period that could even bring us into a 2008-like scenario. So what are the flags that you're seeing there?
Well, I'll tell you right now, everybody, as has been the case for a lot of years now, is all agog over, among other things, what the Federal Reserve is going to do a week from, well, actually a week from next Tuesday or Wednesday, I should say, at their next meeting. Will they raise rates again? Won't they raise rates again? And in my view, Charlotte, there's a lot of misunderstanding about what the Fed is doing. I want to share a couple of things with you here in just a second. You and I have talked off mic about how I can barely draw stick figures. So once in a while, I like to have my cartoonist, Jerry King, who I've used for a lot of years. He's great, nationally syndicated here in the U.S. I'll come up with an idea and say, hey, Jerry, I want to see this, this, and this, and this, because this is what I'm trying to convey about the Fed or about whatever the case may be. So what we have, and I'm going to share my screen real quick. These days, people say, was the Fed inflating or deflating? Are they loosening or tightening? If you go back to late 2019, and this was before the Fed did its more epic inflation of the money supply in the COVID time frame that came a little bit later. You had Powell in the fall of 2019 discover what he euphemistically referred to at the time as a plumbing problem in the system, specifically in repo markets. So after trying and failing to tighten monetary policy for a while back in 2018, and of course the markets famously rebelled, Cargo Plane J, as I called him here, took over from Helicopter Ben, who printed a lot of money to save us from the crisis back in 2008. And then afterwards, I got ahead of myself. When COVID came, he decided he was really going to go nuts. And a lot of people possibly heard this statistic, and maybe yourself, Charlotte. But anyway, in a little over 2 years' time, Powell and his merry band at the Fed created 30% of all of the dollars ever brought into existence in the history of the United States of America. And as that started to get some traction, inflation rates started going up for the first time in a very long time. Everybody but the Fed seemed to think they were sustainable. Of course, there's that famous word when everybody is yelling, help, my house is on fire. And of course, there's inflation. Don't worry, those flames are transitory. Well, now we've learned that they aren't transitory and weren't transitory. So now, instead of the arsonist, we have Fire Marshal J. And some folks in our audience might be old enough to remember a great comedy that was on years ago called In Living Color. And among other things, it's where the comic Jim Carrey got his start. He played Fire Marshal Bill, and he was always a reckless guy. And you knew something bad was coming when he'd say, let me show you something. And well, Jerome Powell is going to show us how he's going to extinguish the inflation that he was the proximate cause of to begin with, but he might take eventually the economy and the housing market and everything with it. Because what we have now is this game of what I've called monetary Jenga, where, and I'll tell you, honestly, Charlotte, looking back 14, 15 months ago, whenever it was that the Fed started all this, a lot of us would never have believed that the Fed could get 500 basis points of rate hikes in without blowing everything up. And they haven't done it, at least not yet. There's been a few banks that have gone under. There are going to be more to come. The Fed has already shown, along with the Treasury and the rest of the government, what the response is going to be. They are, unlike 2008, going to require a lot of big investors to take a hit, even as they backstop individual investors and depositors. So anyway, that's where we're at today. We've got a Fed that is still on the tightening course. They have promised higher for longer is what we're going to be living with, even though parts of the markets, certainly the stock market, still aren't taking them that seriously. So my view is that the Fed is going to continue to try and put some of this inflation toothpaste back in a tube. It will start to have incrementally a more detrimental effect on the economy. It already is in some areas, not everywhere, but some. But there's still a lot of that liquidity out there. You don't create $8 or $10 trillion in 2 years and have it all go away overnight. This is going to be a process, and we'll talk about a little bit of prognostication toward the end of our talk. You mentioned 2008. I think we've already started, and these bank failures recently are an example. We've already started what's going to be a very prolonged period of deleveraging. There will be inflation with it. We're going to have some of the worst aspects of both inflation and stagflation. There will be deflation of some asset prices. It's not going to be a pretty picture, and it's going to be one more than likely, barring some crazy event that speeds everything up. Unlike 2008, this is going to go on over a period of years. So we're going to have to get used to a very, very different world, a different macro backdrop than most investors have ever lived through.
Okay, I think that's a really good overview of how you see the market right now. And one thing I want to pull on is this disbelief in some of the signals that we're getting. So we have the Fed basically telling us, no, we're not going to stop pushing. And we've heard that there could be a recession coming. And yet we do see a lot of hope that there's still going to be a soft landing. So where do you think that disconnect may be coming from?
Well, I think there's a lot of muscle memory, for lack of a better term, Charlotte. You've got investors who got used to the so-called Fed put for so long that as soon as things get bad, the Fed will turn tail, run up the white flag. Sorry, we didn't mean it. We'll start the printing presses again and so forth. And they don't realize that there are a number of reasons why the Fed really is compelled to stick to its guns this time. Jerome Powell himself, gave us early in his tenure as Fed chairman some cause to believe that he would blink and turn tail. At the end of 2018, famously, when he suggested that we could see interest rate hikes continue into 2019, the markets rebelled and he did a 180. Forgive me, mea culpa kind of thing. But back then, inflation was not chronically high. The markets internally were weaker than they are right now. And so I think that he's going to stick to it for a while. The Fed's told us two things over and over again. And look, we can fault Powell for an awful lot of things. As I showed in those earlier cartoons, Charlotte, he was insane to go as far as he did in printing as much money as the Fed did when all it was going to do was drive up prices for everything. Now he's possibly going to overcorrect in the other direction. But the one thing we can't fault him and the rest of the Fed heads for, by and large, is they've been very consistent for many months now of where they're going and what their plans are. Yes, they realize they could cause a recession. No, it's not our base case. We think we can avoid one. But they know they can do it. They know that in the end, they're going to raise unemployment. They know in the end that, last but not least, asset prices will at least stagnate, if not come down further. But they've told us that's what they want. It's a whole other discussion, Charlotte, to have over the nature of our monetary system to begin with. In my view, we should not have a Federal Reserve to begin with. We should not be paying interest to borrow our own money and our own credit as a society. The system itself is where the flaw is, but that's a discussion for another day. It's the hand that we've been dealt, and it's the hand that these guys are dealing with because they're not compelled to play another. So in their world, in order to bring inflation down, they need to, quote, reduce demand. You hear that phrase constantly from Powell especially, but from others. How do you reduce demand? You take money and new credit out of people's pockets. That's all they know to do. And it's like the old saying, when all you have is a hammer, everything looks like a nail. There's a lot of other moving parts that the Fed doesn't have control over when it comes to inflation. But the main one, the supply of money, is what they have control over. And belatedly, they figure that out. So they realize, and they've told us that this is where we're headed. And what it's going to take for the markets to wake up to it, I don't know. As I said, everybody is so used to the opposite that they just don't believe that the Fed is going to stick to this. And even now, after we've had some stronger economic numbers, we've had some, inflation, core inflation has ticked back up again the last couple of months. Um, you know, there's still the view that we're going to see rate cuts by either December or by next January, and the Feds keep saying no. We'll see what they say in about 12 more days.
We will see. We'll be watching very closely to see what happens at that June meeting. I think the one final macro thing that I hoped we could touch on is the banking crisis. And it's another thing that I think we heard so much about, and now it seems to be kind of fading away. And people are maybe looking at that as an isolated incident. Maybe it's just these regional banks. I know you just briefly mentioned that you don't think that this is all we're going to see there. So, what are your thoughts on that note?
The Fed wants to see a deleveraging go on, and I started this and to this to my comments a minute ago. And their litmus test is, are the markets orderly? Okay. You don't want to see a situation develop like in 2008. I remember way back in 1987 when the stock market crashed on that Monday in October of that year. The market gave up a fifth of its value, or a little bit better, in one day. But worse, you had certain companies that you had no bids at all. You couldn't sell IBM stock at any price, not just half off of what it was yesterday. Nothing, nobody. And when you have a situation like that, especially in the banking system and the credit markets, that's where the Fed does have a gun to its head, and they do have to intervene. Short of that, they want to let finally and belatedly, after they made a mess of things on the other side, they want to let nature take its course somewhat. So they fully realize, whatever they say publicly to the contrary notwithstanding, that there are going to be other banks that go under. At the last FOMC meeting, Powell pointed out, I think he was going back 20 years. 20 years ago in the US, there were 14,000 total commercial and investment banks. Today, there are 4,000. It distresses me to say, but we are going to catch up to your country, inevitably, and there will only be a relative handful of banks left. All right. The big ones will gobble up the small ones. As the small ones go under, that will help take some of the steam out of demand for credit in some ways, and all else being equal, help the Fed in its crazy job of inflation fighting by, killing economic activity now. But that's where their brain is at. Okay, so they know that other banks are going to go under, but they've shown their hand as well, and this is a key thing right now, and it's also a key thing in this so-called inflation fight. Things have changed, Charlotte, from when everybody criticized the Fed and the elected officials after 2008 because it was Wall Street that got bailed out. And it was homeowners and investors and stuff that got the short end of the stick. They know that they can't get away with that politically any longer. And so this is why, with the first few banks that have gone under recently, you have seen the new model emerge where if you're a stockholder, in a Silicon Valley bank, you're wiped out. Even if you're a bondholder, you're at the least going to take a haircut. But if you're a depositor, the FDIC now is meaningless, because whatever the amount of money is that's in there, we're going to backstop it. So, one of my mentors going back almost 40 years used to say the FDIC stood for the fraudulent and deceptive instillers of confidence. So everybody is comfortable with the banking system. But even that now, that's an anachronism. I mean, the Treasury and the Fed, they're going to backstop everything. They'll find accounting gimmicks to cover up for it. And that's key. That's key, because they don't want the society to rebel if too many banks do start going under.
Okay, I think this context is pretty important because it helps us understand your background, and this is part of what's making you bullish on a lot of commodities. So we're going to talk about that And where I'm hoping we can start is with gold, which is of great interest to our audience. I'm hoping that we can talk first about the drivers that have taken gold above 2000 for a good chunk of this year. Because I think if we look at what it took it there, even though it has pulled back a little bit more recently, that'll help us understand what it's doing right now. So, what are your thoughts there?
Well, I'm going to share a couple of slides additionally in a minute, Charlotte. But what's happened with gold in recent years is that there are fewer and fewer natural investors in the gold space. Okay. When I first got in this industry over 40 years ago, I started going to gold conferences. There was way more people there. The people who were there were more conservative. They were wealthy, but a lot of them, directly or indirectly, you could trace their lives back to the Great Depression. And so they understood what sound money was about. They understood the investment role that gold plays. And what's been strange to see in a way in recent years is that as central bank demand for gold as a reserve asset has rebounded substantially for some years now and hit new records in the recent past, as some individuals have bought physical gold coins and silver for that matter as mad money to have to barter with in case the economy really went kablooey. There's been a cavern or chasm left between those two elements of demand from investors who for a while now have had a lot of other things to play with besides gold. Okay, so it's the reason why, and I'm going to share a couple of these charts having said that right now quickly. So here you mentioned gold. I mean, 3 or 4 times, going back to the first time in 2011 when we peaked at over $1,900 an ounce US. We've been up in that same area twice in the last year, as you see here. And the latest peak was a bit more sustainable, up around 2000. We're still flitting with that right now because gold's advantage compared to all the other metals is that there is still a reserve and monetary aspect to it. It's not just a commodity. So it is done very, very well as a commodity. But you look at this, and this is one of the more charitable charts I could have used. This is the ETF GDXJ. It's down by about a fifth from a year ago at the same time that gold is the same price. I'll be charitable not to pull up charts of juniors that you or I or our followers may be in, because that's a worse situation. You look at GDXJ compared to gold's first peak in 2011, and it's down by 40% or something like that. You look at the Toronto Venture Exchange, it's down by more than half now, or slightly more than half since 2011. And it's because the investment case for gold has changed in a variety of different ways. In fact, late last year, here's the cover of it. Anybody that wants it, this is available if you just ask me for it. I did the latest rendition of a special issue. This is not your father's gold market. And it most certainly isn't. One of the things, in my opinion, that has hurt the cause of gold and gold equities as investments are the salesmen of those things. And look, I'm not saying that because I'm perfect or I'm right all the time. I'm far from it. But there's a terrible misunderstanding out there as to what drives gold in the year 2023. I continually am hearing talk about, for example, the death of the US dollar, that look at the federal debt and so forth. Well, one of many things I cover in that special issue is this. If you go back to when President Nixon so-called closed the gold window in 1971, and the price of gold from that point to today has no longer been fixed. It was fixed at $35 an ounce. What caused the first massive run in gold in those days, where it peaked a bit over $800 an ounce briefly within a decade, was that it was uniquely the United States of America in those years that was debauching its currency. It wasn't everybody else doing it. And the U.S. was being vilified for it. Charles de Gaulle, when he was president of France, famously threatened to start a run on the U.S. And that's one of the things that caused Nixon to do what he did. Today, when you look in relative terms, the U.S., frankly, is the cleanest shirt in the dirty laundry pile. Everybody else has long since joined this race to the bottom for fiat currencies. And so you need to look at things not in isolation and say what the U.S. is doing, but globally, what are the drivers? Now, look, as I said a few minutes ago, a lot of the world's central banks are buying gold hand over fist because they see a different world coming that is not revolving around the U.S. Yes, the U.S. dollar's role is going to diminish as it has started to do in the recent past. Doesn't mean it's going to go to the ash heap of history right away necessarily, but that's just one of many things. So look, the investors need to have the case made to them. And I'm not just talking about gold bugs, okay? Philosophically, I'm more of a gold bug than most people. But as a practical matter, I understand that there are times that you have to stand aside and at least limit your exposure to the space, no matter what you think should be happening. If everybody else is buying cryptocurrencies and NVIDIA and houses and meme stocks, and they don't have an interest in gold, well, then there's nobody else that's going to follow you and buy the same stock you did and push it higher without a darn good reason. Now, I think that we will see, inevitably, a time come when we get the next significant move higher in gold's secular bull market that did start, in my opinion, way back in 1971. But we aren't quite there yet. There's a few things that have to happen first.
Right. And maybe we can talk a little bit more about what those things that need to happen are, because I think a lot of people are curious about what's going to take gold through that all-time high that it is getting stuck at. And of course, they want to know, all right, so when will those generalists come back in and hopefully push up my gold stocks?
Okay. Gold itself, first of all, I think will be one of the better performers of all commodities again, because as I said a moment ago, it still has those aspects that nothing else has of being a monetary and a reserve asset and being recognized as such. You know, the central banks of Russia and India and China and Turkey and Iran and all Saudi Arabia and all the rest of them, they aren't buying silver or copper or lithium as reserve assets. They're buying gold as reserve assets. So that's always going to have an underpinning there, especially now when the world is fraught with peril. I mean, we really didn't see a significant response in gold as we did in, for example, oil and gas and uranium, which we'll talk about shortly, when Russia invaded Ukraine. But you look at the handwriting on the wall, and that conflict, let alone one that is brewing between the U.S. and China, are going to get worse before they get better. And I do for gold, not gold stocks initially, but to gold as a safe haven asset. You know, so I'm not being quote bearish on gold necessarily. When it first got above 2000 back the 1st of February, we got stopped out of all of our trading positions. We still have some long-term companies that I like that I'm not going to advocate trading out of at any price, because 3 or 5 years from now, I think I'm going to be real happy with them, no matter how much, little bit of pain we need to go through right now. But aside from that aspect, Charlotte, I like to make the comparison, and it won't be perfect, but I think it'll be close, between now and the immediate aftermath of the financial crisis in 2008. Because if you remember, gold, which that summer had finally managed to get above $1,000 an ounce US for the first time, dropped to 670 an ounce at the bottom, because everything got sold off when people had to get liquid when it all fell apart in the summer. But gold was one of the first things to start recovering sustainably, and it took less than 3 years for the gold price to triple. Okay. It wasn't because these imaginary conspirators who suppressed the gold price got kidnapped and couldn't do their dirty deeds back then. The reason why gold tripled was because people other than gold bugs saw a set of circumstances in front of them and said, gee, maybe these guys are right. Look at what Ben Bernanke's doing. Who ever heard of quantitative easing before? Look at all of this money that they're printing now, and it's not going to have any traction. So there's three things that have to happen similarly to 2008, in my view, for there to be a sustained move up in gold, which will also finally take the gold stocks with them. And because people will see the momentum going. And of course, even though it's backwards and it doesn't happen just with gold, the masses of investors always wait for stuff to start flying, and then they're afraid to miss out. They're not smart enough to get in, most of them at the bottom. Number one, the Fed must pivot not just in people's fantasies, but in reality. Okay. You need to get to the place where the Fed doesn't just pause for a meeting, which they may or may not do in June, but keeps possible added rate hikes on the table if core inflation keeps going up. But something needs to make them come out and say, we're done. And not only are we done, but we stand ready to support the economy, the system, or whatever. If a couple of more, if that Jenga tower starts to wobble a lot, okay, that's what we need to hear from the Fed. Number one, we're not close to that. I don't think very close yet. Number two, you need to have the economy bogged down significantly more as the Fed pivots and starts printing money. All right, because if you go back to 2008, 9, and 10, for all of the quantitative easing, for taking interest rates to nothing that Bernanke did back then and all the rest, there was no traction in the economy. So that was why a lot of people correctly looked at the situation then and said, all right, they're printing all this money. It's not resurrecting real estate yet. Didn't for quite a while. We're helping the economy out. It's just a lot of extra money out there. Demand still stinks. So by the process of elimination, gold is going to benefit from this type of thing. And it did. And number three, and it's kind of part of number two, you need to close off other avenues for investors. All right. Because investors basically have had other things to play with. Last year, gold had a decent year because except for a couple other commodities, stocks generally had a lousy year. I mean, the S&P was down 20%. The NASDAQ was down by a third. They both had big rallies this year. So to me, the fact that gold has not collapsed is a glass half full story still, even if it's not quite ready to take off. So you need to see those three things. I think they're coming. They're not going to all come on the same day or the same week. And I think we're talking months rather than years before we see that.
Okay, so you've laid it out really clearly. And now I'm going to ask my last question on gold, which is maybe a little bit tricky. But if we look forward to when we're getting all of these scenarios lining up, what is the price potential for gold in this cycle? What are you seeing? Because I hear so many different predictions of how high we could go.
Well, look, there's been people around for years and years and years that are the gold centric or gold only salespeople. I mean, I remember 5 and 10,000 an ounce predictions 20 years ago. Okay. Hasn't happened yet. It's not going to happen anytime real soon. I don't put a number on things, Charlotte, because I like to look at factors. I do the same thing when it comes to individual stocks. Just a quick little digression here. A lot of people, when they buy a stock, maybe a mining stock, a biotech stock or whatever, there's a standard rule of, when you buy a stock, if it doubles, sell half to lock in, the fact that you can't lose now and keep the other half on the table. Well, I don't want to sell any of it. I want to keep it all on the table if the same circumstances that caused the stock to double are there, if not stronger. So I choose to look at it from the standpoint of once we get those factors that I just laid out in place and gold starts to run, and believe you me, when it does, and you see a decisive break, I mean, it goes through right now you've had 2 or 3 times that the gold price is tagged 2,070 an ounce or so US, and it falters and comes back down. Stayed there a little bit longer this time around than it did early last year, which is good. All right. But when we get that point, when you see it go through that 2070 like a hot knife through butter, and it keeps going and the momentum stops, you don't want to be a seller. You want to have taken your positions and you want to ride that momentum. Of course, nobody knows what the future is going to bring after that. But once we get all of those things in place, and this is how I advise people to manage a portfolio anyway. You're always reassessing your positions, good, bad, or indifferent. If you like something, you add more to it, whether it's gone up or down, et cetera. But I think as long as the circumstances that cause gold to break out stay, I don't want to put a limit on it. I don't want to put a price target on it. I have no idea. Will it be 3,000 this time around? That's a realistic number, 2,500 to 3,000. Could it be more? Who knows? There's a lot of other things that may come into play as well. The dollar is not going to lose its status as the chief global reserve currency anytime real soon, probably not even in my lifetime. And I regret to say that, because if the dollar was not the global reserve currency, the world would be a safer place, which is a whole other subject, like the Fed itself that I said earlier. But that's going to enter into it in a bigger way at some point as well. When the U.S. is having a harder and harder time getting the rest of the world to buy its paper, and there's going to be more of a homespun inflation here. That's going to be a dynamic. So we'll see what happens, but I'll worry about it when the circumstances that caused gold's breakout eventually change. Then I'll worry about, okay, well, do we get out here or here? So I'm not going to be like everybody else and pick a number today.
That's fair. So constantly reassessing if and when we get there, and we'll see how it goes. Okay, so we made it through gold. And, I did mention, of course, this is not the only part of the resource sector that you're bullish on. And you've written a lot about the new FAANGs. This was a term that I hadn't heard before. Gold is part of it, but I wondered if you could give us just a brief overview of what that encompasses, because it's pretty interesting.
Well, I have said in a couple of things which I've shared with you, I've got videos on this. I did another new issue just back in April on the new FAANGs theme. To me, it is one of the single most important themes that investors need to get their heads around today. The old FAANGs, of course, that everybody made easy, passive money on for years were Facebook, Apple, Amazon, Netflix, and Google. The new FAANGs, and that term was not coined by me, but it was coined by an analyst report out of Bank of America early last year. The new FAANGs are fuel, agriculture, aerospace, N is for nuclear energy and other zero carbon emitting sources of energy, and the G is for gold and other metals and minerals. And when it comes to the substances in these things, particularly the metals, minerals, really almost all the way across the board with all of this stuff, what you've got in varying degrees, but with virtually all of these materials, Charlotte, is years of underinvestment, underdevelopment, at the same time that the world is growing population-wise, GDP-wise, and otherwise, and needs ever more of these things. And that was before policymakers decided they wanted to come up with this green economy of the future, which I support, generally speaking. And now that has added to the long-term structural deficits of these things. So some people are familiar with Jeff Curry, who is the chief commodity strategist at Goldman Sachs, and he has repeatedly said for the last couple or 3 years now, as long as anybody, me or anybody who is out, especially on uranium early on in this stuff, saying that this inflation during this period of time, this period of history, this developing bull market, secular bull market for commodities, is not dependent on a cheap dollar, as has happened in the past. It's really not even that dependent anymore, even though the market gyrates a lot on China news, to what China is or isn't doing. Is China, recently, for example, a lot of the weakness in energy and copper has been people second guessing how much China really is rebounding after opening their economy back up. And according to Curry, that's not even the biggest driver. The biggest driver is that the stuff isn't there. You look at the average age, you and I were talking recently about this. You look at average age of people in the oil patch in North America, it's pushing 60 years old. It's not a whole lot different in mining and other extractive industries and in the different industries and skill sets required to support all of those things. Who wanted to go to school for the last 30 or 40 years with the secular bear market for most commodities for a variety of reasons, with all of the encroachment of radical environmentalism? I'm an environmentalist, but I'm sensible about it and realize what mankind's needs still are. But you look at all of these things that have been part of the political discourse, the societal discourse, it's discouraged every aspect of continuing to develop the things that we need. The only place where that hasn't happened is in a lot of developing countries, which still, frankly, the West still tries to exploit as much as it can to get cheap resources so that the people at home can feel good about being green and environmentally friendly. We'll just screw up somebody else's environment, okay, to get the things that we want. And that hypocrisy is ending because a lot of these developing nations now have had enough. They want to get their share of their wealth. They don't just want Europe or the US or China to come in and take stuff and leave with some crumbs. So, every aspect of the whole commodities thing is just extraordinarily bullish. And this will be a good segue. I know you got some questions, but this will be a good segue for my last few slides that I want to share. Now, there's an old saying that that an investment craze, real or imagined, fad or not, fundamentally sound or not, you can judge it by your shoe shine boy, your taxi driver, and whoever, all right, telling you about it. So in the recent past, your taxi driver or Uber driver might have been telling you, hey, did I tell you about the meme stock I bought? Did I tell you about buying GameStop or GameStop rather? And that kind of thing. I don't know exactly when, but after several more years, that same guy is going to be telling you, hey, did I tell you about the critical material stocks I bought? Did I tell you about the uranium stocks I bought? And that's one more I want to share with you. This was actually commissioned intellectually by a good friend of mine who's a CEO of a junior resource company, part of which has as its focus uranium. I have said many times that, and this is in context of the gold market, that when from time to time generalist investors wake up and realize that they want to get in on gold as well, it's like a 300-pound man jumping into a kitty-sized wading pool. But when uranium becomes part of that, some of the other battery metals, so to speak, and so forth, this is going to be an elephant jumping into a kitty-sized wading pool in the years to come. We've seen some of the initial taste of that for the last 2.5 years with uranium stocks that have done well. You go back to the bottom 3 years ago, and the uranium sector is up 4 or 5-fold, just generally. You look at some of the other energy stocks, lithium has done well. We've had a couple 10 baggers just in lithium stocks in the recent past, but it's going to broaden out and become the story, I believe, that people are going to talk about in years to come, as this massive disconnect between the fundamental strength and value of a lot of commodity stories and the lingering idiocy because of that muscle memory with people chasing the old FAANGs anew and with the broad stock market and so forth. We have, I believe, and it's not been all in a straight line clearly yet, we have started almost imperceptibly that period that a lot of people have pined for and prayed for and predicted for years, where we were going to have a sustained time where commodities do outperform financial assets and become the big, broad investment story. So that's why it's the new FAANGs.
Yeah. And, new fangs, that could be an entire conversation on its own. And
Yeah,
in fact, you've done an entire presentation on it that I did watch. So maybe we could link to that for everybody.
sure.
The one I want to hone in on just briefly is uranium, because that's another strong area of interest for our audience. And there's so much that we could talk about there. I think I'm just going to leave it at, for this market, it's something that we've been waiting a really long time to see it move. And actually today is, as we were talking about before we turned the camera on, today is a good day for uranium investors. But what are the main factors that you're watching there? What should people pay attention to as they kind of wait for that momentum to continue on upward?
Well, I think this is just the first fruits that we've seen over the last 2 to 3 years. This is going to get a lot bigger than this, Charlotte. Of all of the areas that we could discuss of trying to reduce carbon emissions globally, all the different targets that governments have set, some of them just pulling a number out of the air with no idea how they're going to get there. Of course, that's been one unfortunate part of very poor planning. At the same time, we've seen policymakers that have really hamstrung the type of things they claim to support. You look at how slow permitting is. You look at how many roadblocks are put in front of projects. I remember, and I'm just going to give one quick example. It's been nearly a quarter of a century since the first time that I set foot on a NorthMet project in Minnesota's Arrowhead. That's a project owned by a company called PolyMet. Well, I should say owned by, they're down at an 18% interest now because over so many years of court fights and everything else, they've had to continually go to their big brother, Glencore, which now owns a majority of NorthMet. That's a tragic thing for the early investors in PolyMet as well as for the communities involved. But for 25 years, you've had a situation where that project and many others in the US have been slowed down or stopped that would give us the type of critical materials that we need. Two of the 10 largest nickel resources in the world are in that iron range. You've got the Polymets and you've got the one that Twin Metals has. That's owned by Antofagasta from Chile. So there's been a lot of stupid stuff that has happened where our policymakers have given us these goals, but taken away the tools. The cartoon I should have had on here on this subject, I'll just describe it real quick, Charlotte, is we've all watched the Ten Commandments, at one time or another, the great epic movie. And when Charlton Heston pissed off the Pharaoh said, well, I'll fix you and your people. You're going to have to make your tally of bricks, but I'm not going to give you straw. Let's see how you try that one on for size. So the cartoon that I had shows Joe Biden as Pharaoh behind the podium, bunch of Secret Service agents with sunglasses in front of them. The audience is a bunch of miners and engineers. Says you can't have critical metals, but your tally of electric vehicles shall not diminish. So that's where we at. But I got off on that to make the point that the least bad story of all of the critical materials has been uranium and nuclear energy, because the light bulb went off over everybody's head except for Germany, which still doesn't get it and still thinks it's going back to strip mining for coal is better than keeping their nuclear fleet, which they've been a laughing stock of the world on this recently. But save for Germany, everybody now gets the fact that there is no single better way to provide 24/7 juice for power grids with zero emissions except for water vapor. All right. Everybody finally figured that out again. And when Greta Thunberg, the scold of the world, says, yes, we need to use nuclear energy, that nuclear energy ship is sailing. So, but at the same time, and especially here in the US, where we've got a couple billion pounds of uranium in reserve and haven't produced any in quite a while, this is a great bull market getting ready to really take off, because policy-wise, even though it's far from perfect, at least there's some effort here in the US to set up a strategic uranium reserve to get us off of Russian uranium, and especially enriched uranium. So you've got a whole menu of investment opportunities out there. Uranium miners, the companies that make small modular reactors and all the technology that goes with that, the companies that have all of the building blocks right down to, or up, you might say, to the utility infrastructure itself. Why do you think Cameco joined forces with, I think it was a BlackRock, to buy Westinghouse a year or so ago? So this is, of all the stories, and they're all good in their own way long term when you look at supply and demand fundamentals and whatnot, but there's not a single better story than uranium in my view right now. And even after the move that we've seen from, the spot price bottomed at 17 or $18 a pound, we're now getting back up to the mid 50s. I think the peak, you remember what the peak was, Charlotte, last year, 62 or something like that a pound?
Something like that. Yeah.
We're going in the next 1 to 2 years, and this I will put a number on because I've got a much better idea of this. We're going to see $100 a pound again for uranium inside of 2 years.
Okay. Thank you for going into that. We've covered, in addition to uranium, really a lot of ground today. So really glad that you could take the time to go through. As we are finishing up here, I'm wondering if you have any final words of advice that you would leave investors with as they're taking in all of this information.
Well, my motto for my newsletter is that you can get information anywhere, but here you get knowledge. So I try and dispense that knowledge, and that comes in two key themes right now. Number one, we are in what I've called the great stagflation. We are not going, barring a global depression that temporarily brings price increases down to these levels, we are not going back to the disinflation, sustained 2% or less inflation days anymore. There's so many structural things that have changed. We need to get used to chronically higher inflation and interest rates to go along with that. So people need to understand that and realize that we've got a much different investing landscape than we ever have. So understand that macro thing. And the other, which kind of ties that in with the new FAANGs theme, Charlotte, is that nobody listening to the sounds of our voices today has ever lived in a world that did not revolve chiefly around the United States of America. Our currency, our military might, our will, our dirty tricks, when it comes to that, anything. The U.S. in the post-World War II era has been the anchor in virtually every respect of everything that's gone on in the world, economically, commercially, markets, the whole deal. And again, that's not going to go away overnight, but we have started down the road toward ending this globalization regimen, toward the U.S. getting its way every time we say jump, and we expect everybody else to respond how high. Those days are ending, and alliances are shifting. We're seeing a situation where even former friends are saying, well, we want to join the new BRICS. The BRICS block. We'll still trade with the U.S. We'll still sell you oil, but we're not going to maybe do everything the way you want it done. As that evolves, it's going to dramatically reorder our lives as consumers, as investors, as citizens. And that's something else people need to come to the understanding of. This, and I hate to say this being an American citizen, but this kind of jingoistic attitude that we've had for so many years that what doesn't stink and everything in the end benefits us. We got to get used to a different world as the years go by. And that will, especially when it comes to commodities and currencies, where I believe a form of World War III has already started over commodities and currencies. That's going to change things a lot too. And there are ways we need to respond as consumers, as citizens, and as investors.
Okay, I think that sounds like a good place to wrap up. You've left us with, as you said, a lot of knowledge, not information. So thank you so much for coming on to share. It was really great to have you.
My privilege. Anytime, Charlotte.
Of course, and once again, I'm Charlotte McLeod with the Investing News Network, and this is Chris Temple with the National Investor.